What if you invested $15 a day into the S&P 500, the same index that's created millionaires for a number of years? In this video, I'll show you a daily habit I'm using that could snowball into life-changing wealth and how long it could take to hit 6 or even 7 figures. You're not going to want to miss this simple strategy that could transform your future. I'll break down exactly how it works and why time in the market is a powerful factor. Let's get into it. The market has had historical returns of 10% per year. So this means that if you invested $15 a day, which works out to be $450 a month, you could start this snowball effect now. Let's say you started this at 35 years old until the retirement age of 65. After these 30 years, you could have more than $1 million. Now let's say you have even more time on your hands. Starting this at 25 years old, this compounding could grow even higher to $2.8 million. Now, how do you actually do this? The first step is finding an S&P 500 ETF. There's several available on the market, but some popular options are SPY and VOO. Now, the S&P 500 stands for the Standards & Poor's 500, which is a market index tracking the performance of 500 of the largest companies listed on stock exchanges in the United States. When you hear people talk about how the market performed, they are usually referring to the S&P 500 index. Now, most of the large companies in the S&P 500 are ones you have probably heard of, like Nvidia, Apple, Microsoft, Amazon, and many more. This list is regularly updated, so based on these companies' performance, the S&P 500 will get a rebalance. This is done usually on a quarterly basis. The ETFs will handle all of the changes to the fund, so this makes it very simple for investors. So looking at some of these options, as I mentioned, there's plenty of ETFs to track the S&P 500. The main difference between them is the management expense ratio. All this means is the fees paid per $10,000 investment. Now for this video, I have been investing in VOO, and their management expense ratio is 0.03%, which works out to be $3 in fees for every $10,000 invested. If you look at the holdings of VOO, we'll see all of those companies that we mentioned earlier. So Apple, Nvidia, Microsoft, Amazon, and so on. This ETF is going to track those S&P 500 companies, and they are going to make any changes to the index that happen on a quarterly basis. So this is how I'm going to be buying into the S&P 500. I set up automatic purchase orders on my investing brokerage. So every single day, I have a $15 purchase going through to pick up a small piece of VOO. I started this in September 2024, and we are closing in on 50 days for this experiment. So far, by investing $15 every single day, I have brought the total to $656.43. This means that I am up 2.58%, which makes my profits about $16.54. So as we mentioned before, the S&P 500 historically returns about 10% per year, but we are 2 months into this experiment. So in theory, we should expect to be up about 1.6% in returns so far. We are a bit above this, as I mentioned, we're up 2.58%. So it looks like we're currently on track to get that 10% per year. Now, I know what some of you are thinking. What would happen if I went for a monthly approach rather than this dollar cost averaging strategy? Dollar cost averaging can be a good strategy for investors like myself that want to mitigate the risk of investing a lump sum at the wrong time. As an investor that experienced the 2021 crash, I have to credit some of that fear to that time span. This strategy works for me as I am focused on time in the market. I know that the longer my money is able to sit in the S&P 500, better chance I have statistically of getting results. Vanguard also discussed a very good article on the effects of lump sum investing versus dollar cost averaging. They did an analysis on the world index's returns from 1976 to 2022, and they calculated that lump sum outperformed dollar cost averaging 68% of the time. They came to this conclusion by comparing two strategies using 10,000 return scenarios. In most cases, lump sum had a greater wealth after 1 year, but also greater losses in some of the worst market environments. They concluded this article with the following statement: a CA or cost averaging strategy is superior to remaining entirely in cash, and if implemented properly, may be more suitable for risk-adverse investors. What I can take from this is that it's all up to your own risk tolerance. For me, I do have some fear with all the record highs in the S&P 500, as well as some fears of crashes that has been brought to light by the media recently. But the reality here is that nobody knows what's actually going to happen to the market, if it is going to continue to rapidly grow, or if a crash is actually going to happen. For my personal portfolio, I already have a lump sum strategy that I'm using for other ETFs, and implementing an S&P 500 holding into a retirement account with a time horizon of 30 to 40 years is my plan. Seeing that this small deposit every day could turn into over $1 million thanks to time in the market. It's a strategy that I feel suits my overall risk tolerance. Let me know what you think of lump sum investing versus dollar cost averaging in the comments below, and be sure to always consider your own financial situation before implementing an investment strategy. Your financial situation may be different to mine, so be sure to pick a strategy that fits your own needs. If you made it this far in the video, be sure to like, comment, and subscribe for more financial education related content.